Hi, good afternoon. I know I'm between you and lunch, so thank you for enduring about 10 minutes. My name's Gerald Brady. I run the bank here in the UK. I've just moved back after 14 years in the States, and spent the last 5 years with the bank in Silicon Valley. So I'm going to give you 2 seconds on the bank, just in case you don't know us. So all we do, and all we have done for the last 31 years, is bank technology, life sciences, and energy companies, and the funds that put capital into those businesses. And today, we now bank 16,000 companies. We bank 65% of all venture-backed companies in the USA, and we bank 1,250 funds around the world. We got our bank license 2.5 years ago in the UK, and that was a multiple-year process, 5,000-page bank application to get our license here in the UK. And we're very much focused on the same group of people, working with the entrepreneurs, providing the debt piece of the equation, and taking deposits. We don't do any of the investment banking stuff. We don't do M&A work. So we've got quite a simple business, and we've been growing very well, as you can see with the numbers back here. So this year, we're at 38% deposit growth this year, and 13% loan growth. So we're one of the banks that didn't get in trouble with the financial crisis and really investing in the innovation economy. So credit, it's all about perspective. Most of you in the room today care about the tech world, and credit in your world is actually very good and very alive. And it would be the same conversation in the States, it would be the same in India, same in Israel, same in China. But the headlines will tell you that the banks have stopped lending. And what you're really seeing is it's a handful of banks, the big banks, who clearly have had a lot of challenges. But this headline, I didn't choose one about Silicon Valley Bank. This bank is focused on retail banking and small business banking outside of tech. Aldermore is a challenger bank. That's what we're called here in the UK, challenger banks. We're taking on the big guys. And you can see from the headline in the Financial Times earlier this week that these guys are really starting to put money to work. And we in Europe, we're at 1.1 billion in loans, and we got our bank license 2.5 years ago. So we've been very aggressive growing the business. But if people tell you banks are not lending, that's not true. It's some banks have stopped lending, or the criteria for them to lend has changed and it's got much harder. And this chart here just shows that it is across Europe. You can see that bank lending has come down across Europe. And part of that, I think, is just people's own psyche. Debt is bad in a downturn. A lot of people saw their house prices come down, they saw credit card debt go up, and they saw their own debt challenges there, and the banks on the whole were not very sympathetic to many of the people there. So what's happening in the retail world is very different to what we're seeing in the commercial banking world. And my take is that today, if you're a tech company, you are seeing pricing as good or better than before the crisis. And that would be true in the States and certainly true here. And if you look in the private equity side of the world on buyouts, you're seeing pricing certainly below 2007 levels today. Interest rates are at near historic lows. Banks do have capital to lend, and tech companies are certainly a growth part of the economy. So you're in the privileged position as companies that this is a very, very real option for you. And if you're an entrepreneur, this is also the non-dilutive part of capital coming into your business. So most of us in this world would be taking maybe warrants just to give us some yield, but it's a growth part of the business, it's a real dynamic part of the business, and there are funds and banks looking for companies across Europe to invest in as debt providers, alongside the equity part of the equation. You can see here some of the numbers that if you're an unprofitable company, that still presents a challenge to most of the big banks. Most of the big banks don't really understand what we would do in what we call venture debt, which is lending to often loss-making companies who've yet to break through into revenue or maybe break through into profit. Many of these companies have chosen not to be profitable yet. They're still in that high growth phase. And that, for many traditional banks, still on their traditional credit scoring models, doesn't compute to a good credit. And we take a completely different attitude. And you go back to our bank being founded by entrepreneurs, they understand that early stage software companies or tech companies go through a growth cycle. They're going to lose money, they go through the valley of death, and then they raise. And the real challenge for the companies isn't revenue, it's can they raise the next round of capital. And so we saw that opportunity 30 years ago where we would be the debt part of the equation, very supportive to these companies as they came in. And you're seeing other banks and other funds increasingly looking at that as an avenue. That's the venture debt part of the equation. As companies mature, you're also seeing very traditional bank terms there. You've got the traditional loans that you would imagine that amortize over a number of years. You're seeing working capital. And what's interesting is if you go across Europe, you've got similar challenges in most of these markets. Regulation is a tough part of this. You know, banking and lending here in the UK is an unregulated business. It is a regulated business in Germany, so it's hard to be the disruptor in a market like Germany for many startup institutions. We do see the market being very positive. We've seen very significant growth this year, and as I say, if you are an entrepreneur, this is a great time to be having conversations about not just equity, but also debt, because there are plenty of people interested in putting debt into companies. Now, we're particularly focused on the UK. That's where our bank license is. But many of the VC firms that we work with are investing across Europe, and many of our portfolio companies are active across Europe. So our perspective and I'm going to rush through this, sadly. If you're in the Benelux area, Netherlands, Luxembourg, it's good. There is capital there. Some of the local funds and banks are definitely putting debt into institutions there. Same in Scandinavia. And again, you have great examples of great technology coming out of this Nordic region, and you will see capital go where talent is. Germany, it's tougher. The concept of venture debt does not exist in Germany yet. So it's a market that we're very aware of. We certainly have the opportunity of working with a couple of German companies to date and some of the funds there. There's great technology coming out of that. But there is, to our perspective, a lack of venture debt. As the companies mature, then there's a lot of capital available, and you've obviously got the large banks at the mature company and growth stage company stage. France. Sorry if there's any French people in the room. My mum is French, so I can say this. France has been incredibly challenging for anyone but French banks. It's a very challenging place because one of the reasons is that a bank in bankruptcy, it's actually at the judge's discretion how assets get distributed. And that makes it very hard for banks for most banks to think about debt. Now, the French government have a loan guarantee scheme in there. So they are certainly trying to do things. We do think it is improving. There is a vibrant venture community there. But if London was considered a French city, it would be the 4th largest French city. So there's a lot of French entrepreneurs coming here because of some of these issues and access to capital, plus tax, et cetera, et cetera. Spain, I don't need to say much more. It's just been very, very challenging there. There's a very small venture community. There are some great companies coming out of there. What we are seeing are some Spanish companies who are choosing to be UK topco, and then UK banks can lend into those companies, but the Spanish banks won't. So, looking at alternative lending, and this could be a separate conversation, this is a huge growth opportunity. Many of the brands up here you'll recognize. Wonga's obviously been in the news recently. Market Invoice is a very interesting company, providing working capital on a invoice-by-invoice basis to early-stage companies. And you're seeing a continuing growth of peer-to-peer alternative funders, and this is across Europe. It's not just something that's happening in the States. And you're seeing very, very successful businesses like Zopa here funding circle here. And we think this will be a much more material part of the debt consideration for people over the next few years as well. And then finally, in terms of the venture lenders out there, it's not just us. Krios has been around for about a decade here in Europe, and certainly active in the marketplace. And then Columbia Lakes is a new debt fund that established in the UK a couple of months ago. And so you are seeing debt funds coming in here. They can lend across Europe. They're not restricted in terms of geographies. So my final message to you would be, debt is alive. It is very affordable. If you've got an attractive opportunity, let us know. But don't believe the headlines. There is debt available, particularly for tech companies. So with that, thank you, and enjoy your lunch.